Good afternoon, everyone. They say success is hidden in your daily routine. Well, to tweak it a little bit, I would say that knowledge is hidden in your weekly routine. Sharing knowledge, information, recent amendments, and latest updates through our experts has become a routine of sorts for us at the Institute of Company Secretaries of India. This Wednesday, we bring to you yet another session of the Master Knowledge Series Triple E. Closing in on the silver jubilee of the series soon, it is indeed our thoughtful effort to bring knowledge on your mobile and computer screens, at your click of a button, at your fingertips. The topic for today's session is close to both corporates and corporate governance: shareholders' democracy and activism. Another term that has been accorded to this topic is that of shareholder-driven corporate governance. With the modern-day deliberations encircling around the themes of ESG and sustainability, it has become imperative for the shareholders to voice their concerns and play their roles in governance when need be. And this democracy and activism extends to both institutional investors as well as any shareholder who can impact the corporate decision-making through their votes. Simple as it may sound, with great power comes great responsibility. And to understand our roles and responsibilities in this entire scheme of things, we have amongst us Mr. Sriram Subramanian, founder and managing director of InGovern Research Services, India's first proxy advisory and corporate governance advisory firm since 2010. A firm which advises companies and investors on investor engagement, corporate governance, and shareholder activism. His 3 decades of experience with global capital markets includes heading Wealth and Asset Management Consulting Division of Infosys Consulting as well, and MS in Financial Engineering from NTU and Carnegie Mellon University, USA. His inputs are sought constantly by regulators like SEBI, MCA, and FRA. His presence is also solicited on the Technical Advisory Committee of NFRA, National Committee of Financial Markets at FICCI, National Committee of Financial Reporting at CII. And it is our great pleasure to have him here to address us, guide us, and share his insights on the topic. We welcome you, sir, at the 24th webinar of the Master Knowledge Series.
Thank you, ma'am. Thank you, madam. I will look forward to this interesting session, and I hope the participants have a lot more questions, and I welcome more questions. They can probably type in the chat, and then subsequently we can take it. I have a presentation, so I understand that the overall session is for about 2 hours. So I think I'll cover about an hour, hour and a half kind of a duration, and then we'll open it up for questions.
Sure.
I think that would be the right way. So let's jump into it. This is a very interesting topic, and as InGovern, the topic is shareholder democracy and shareholder activism. What does it mean? Why shareholders? Many of you are company secretaries or from the corporate side. But you, as a company, the moment you are listed, you have a lot more investors. The universe of investors is literally the who's who in the retail as well as institutional world. And it could be global world, right? I mean, it could be global investors. So let us look into how India is defining what is this new thing called shareholder activism, and what are the changes, or how you as a company will respond to many of these dynamics, right? We are not so much, corporate law is much known to you guys. We are actually external to corporate law, but yet we persist. So let us see how corporate law in India. So how many of you know, this is a sort of a quiz question, July 2021, a Nifty 50 company, a reappointment of managing director, this person was voted out. Okay, many of you can put it in the chat, you can type your responses. If you see, this is a marquee company, but yet the reappointment of the managing director, and the managing director lost his job. This was a promoter director, and yet they lost the job. How is this possible? This brings to fore, I would say, shareholder democracy in that sense. Just like with our general elections, where you know that each shareholder gets one vote, here also the same way, one share is equal to one vote. You all know this. And of course, there are various proposals that are placed to shareholders. And so what are the issues primarily here? Two issues. One is the shareholding pattern of the company itself matters, right? I mean, in this case, the company had the promoters owned only about 30% shares. The rest, 65%, is held by institutional as well as retail shareholders. So the voting becomes very diffused in that case. Two is clubbing of proposals. As you know, the company secretary of the company, in fact, clubbed, and this is a general practice that we know in corporate India today, that reappointment of director and the compensation paid to the managing director are both clubbed in the same proposal. So in July 2021, it was a COVID era, right? I mean, we were in the midst of the second wave of COVID. All of you know this. And shareholders were very, very, I would say, sensitive to remuneration. So when the company here proposed that the commission to the managing director would be increased from 1.5% to 3%, shareholders were very angry. In a year when employees had lost jobs, when there was, I would say, an environment which was very, very scary, at that time somber. So at that time, shareholders were very closely scrutinizing remuneration. And this, as I tell you, year after year, compensation of MDs, CXOs, executive directors is becoming all the more important. But the company secretary of this company made a mistake by clubbing these two proposals. So while shareholders were unhappy with the remuneration, if there were two proposals, shareholders would have voted against the remuneration. Okay, but since both the proposals were clubbed and this was a special resolution, it got voted out. So in the process, the reappointment of the managing director also got voted out. So this is a tactical mistake made by the company also, right? If the company secretary and the management had put their head together, they would have been smart enough about this. And this is where I think general practice in India, even to this day, even this last season, even today in postal ballots, we are seeing these two proposals getting clubbed. Okay. So you got to be, as a corporate, be aware that there is a chance that you will be voted out. Investors may be unhappy with the remuneration, but you may lose your job because of that. Okay. So this is I call it a marquee example. I hope, ma'am, can you read out how many of them have chatted any of the right answers? I don't see any chats out there. Nobody has typed in their responses.
So actually, in this mode, we will not be able to see it. It will be on a different platform altogether.
Okay, sorry. Then I was not aware of that. Thank you.
No issues.
Yeah. So the company, of course, is Eicher Motors, as you may all know. And then subsequently, what happened is they came out with another proposal, postal ballot, and there they had separated these two proposals. Firstly, secondly, they said that historically they had never paid more than 1% of the profits as commission to the managing director. So they capped it at 1.5% itself, or 2%. So they reduced the commission payable. Okay. While companies may call it as an enabling resolution, but the moment the power goes out of the shareholder to the board or the NRC, shareholders are very angry. Why should I give away my power and right to the NRC? This we hear consistently from companies that this is an enabling resolution and we are giving the power to the NRC. But the problem is the moment a shareholder gives away the right to the NRC or the board is up to them to decide obviously the boundary conditions, right? And shareholders are assuming the worst, that is 3% would be paid as commissions. So that's where it's very important to look at even the nitty-gritties of any proposal that you place in front of shareholders. Okay, this is an example. Obviously, there are many more examples of smaller companies, etc. But here, Eicher Motors was a marquee company. It is well regarded by investors. You know that its PE ratio is very high. It's a Nifty 50 stock. Its growth rate is very high. All mutual funds own it, and they vote against this. So
we get to see some correct responses on this one.
Yes. So no longer is stock performance equal to shareholder, I would say, this. Just because the stock is performing well, companies say, oh, the stock price is going up and up, so we are happy. No, if the stock price could be going up, but if you are putting forth proposals that shareholders don't like, they are going to vote against. That is the reality of corporate India now. And why has this come about? This has come about because of how the Indian market is structured now. Today, as you know, on the stock exchange, about 2,800 companies are listed on NSE, 5,000 odd, of course, many are zombie companies or defunct companies on the BSE. Actively traded about 1,500 companies, right? And our market cap, as you know, all know, has crossed $4 trillion in terms of USD, which is a good thing. And we hope that the GDP will grow to $5 trillion. And obviously, the market cap also will increase. But the types of investors, if you see, FPIs, foreign portfolio investors, mutual fund families, pension funds, hedge funds, even the retail investor, they are owning 8%. Okay. So this ownership structure, of course, these statistics keep changing. And how often does this ownership structure change? Many of you know, changes by the minute, by the end of the day. Every day it keeps changing. But promoters on average in India own about 50%, right? So it's important to look at the shareholding pattern of a specific company when the proposals are placed also, right? So, of course, the big people who look at shareholder proposals or are activists in that sense are increasingly becoming activists are the institutional shareholders. Okay, what is the perception? What is the reality? This is like the standard in the boardroom. You cannot just blow away the money, right? The shareholders will not be like our three monkeys with Gandhiji has put out. They will not be silent spectators. They will see that you are blowing up the companies and the shareholders' money. They will also not be just this one, and they will not be quiet about it. Okay, they will be very activist. They will open up. They will not be like the monkeys of portrayed by Gandhiji. They will be completely. So this is the reality. This is changing, right? No longer are the days when shareholders would be silent and benign. Okay, they are going to be vocal about their rights. So, but why corporate governance? Okay, this is from a book called Corporate Disclosures by Shankar Jagannathan, who he has written a very fabulous book. You could all refer that. So there is this one between ambition. This is a Venn diagram. Avarice means greed, right? At one end, it is good to be ambitious, but if somebody is overly ambitious, that becomes avarice. You have seen in the past many business houses took lots of debt, went bonkers, got greedy, and then became bankrupt. Many IBC cases, etc. Okay, so that is avarice. In some cases, genuine business cases. In other issues, they are, of course, they have taken away money for personal gain. Right? Apathy is where the company doesn't care for the interests of the minority shareholders or the public shareholders. And this is one class of companies which you would think so. Which class is it? Just think, this is the public sector enterprises. All these did not even meet, many companies do not even meet the requirement for number of independent directors, women director, they don't have the requisite number of women directors on the board. So some of these are corporate governance structures which are applicable to public sector companies, also listed public sector companies, but they don't care. Okay, some of them are non-compliant. Okay, this is I would say, apathy towards. Of course, things have changed this year, especially in 2023. The stock prices of public sector companies have gone up, but it has to be seen whether that is due to mindset of the change in management, the mindset change of the management, or that is they will be more investor friendly, they will put out data, they will reach out to investors, etc. That is not yet happened. I don't think on the ground there is a substantive change in how the management views or interacts with investors. Okay, parameters that are considered and which form many of these corporate governance structures in that sense is board as a collective. Are the skill sets complementary? Many a time we see that the skill sets are not complementary. Of course, many of these are getting codified now in the corporate governance code by SEBI. So these disclosures are coming in the LODR itself, and annual reports have many of these as now templates itself. So to that extent, corporates are disclosing. Okay, but are they doing it? I would say in the spirit of what is required, right? One company, for example, that we advised, a 10,000 crore market, it aspired for almost 50% of revenues from exports. Okay, but none of the directors, there were only 6 directors, none of the 6 directors had any global experience. Okay, so if you have not even interacted with clients abroad and or this one, how would you expect to, I would say, understand global customers or have global factories? They acquired one company in the US, they acquired one company in China, but yet how would you understand those, right? So this is a suggestion that we gave to the company, and the company then brought in somebody who had who was an ex-Apple executive who had worked in the US, right? At a senior level, and then they brought him as a director on the board. So that I would think is companies have to inherit the spirit of complementarity of skill sets, right? Directors, as I told you, now shareholders are looking at the expertise of each director on the board. Independent directors, when it comes for even reappointment or appointment, as you know, independent directors reappointment is now a special resolution, right? So that means that the power of the shareholder has increased for reappointment of independent. So now you got to see whether the independent director being appointed has a requisite expertise, is contributing to shareholder meetings, etc. But obviously, board meetings and all. Obviously, we as external people or investors can only judge one metric is attendance, right? Previously, what used to happen, there were instances where independent directors used to attend 0 meetings, and not too long ago, just 10 years ago. Okay, since the new Companies Act came and all these shareholders started voting, that's when things started changing. But even 10 years ago, there were instances where independent directors would attend 0 meetings. Okay. Even recently, we see new age companies, that is the newly listed companies, when they put out prospectus, etc. they have numbers where the independent directors' attendances are very, very low in terms of percentages. Okay, and that should change because otherwise it's like I don't attend school class and then you expect me to get good marks. No, you are actually taken out of school itself, right? So that attendance is just one indicator. People argue that no, the director spends time and effort and they don't need to attend. And as you at ICSI know, now no longer is physical presence necessary for board meetings. One can attend over video call, and the companies can organize video calls for their directors, and they can attend. Video attendance is also counted as attendance, right? So to that extent, independent directors, again, as you know, the good part is in 2024 now, 10 years after the companies as new companies has kicked in. Now the grandfathering of independent directors tenure is gone away. Right, 2024, there is expected to be a big churn of independent directors. 2 terms of 5 years each is what the new Companies Act has specified. So tenure becomes important. No longer, there used to be cases, even with storied companies like Colgate, Pfizer, etc., where the independent directors used to be on the board for 30 years, 35 years. Okay. There was a joke going around that the independent director's tenure is more than that of the furniture in the boardroom, right? So that is the this one pecuniary relationship. We notice in some, not so many cases, but in a few cases where the independent directors are either lawyers whose law firms is providing service to the company, right? That is always considered a red flag. If the independent director, you can, companies argue that we need the expertise of the director. Then that director can always be classified as a non-independent director. And we recommend that if you, as a company, think that the director's expertise is needed, you can always classify that director as a non-independent director. Why classify as an independent director? That's when the conflict of interest or a pecuniary relationship happens. In fact, in a book called Financial Shenanigans, which is a very well recognized book, they have, the author has quoted that this pecuniary relationship, wherever it was prevalent in the US, there was huge red flags, there was corporate fraud, etc. So in India, obviously, we have not seen cases of corporate fraud subsequent to this, in that sense, because of this. But yet, why give scope for even foreign institutional investors to think and be a red flag? You as a company secretaries should advise the management to react in such a way that there is no pecuniary relationship. That I would say, especially lawyers, we know one of the large segments of people, independent directors, are lawyers whose law firms provide services to the company. Right? Board committees, again, just like as a board committees also either complementarity of skill sets and expertise, right? So these are changes which will keep happening. And now, obviously, the mandatory committees and all these things are now put out. In fact, in today's this SEBI discussion paper, if you see, the stakeholder relationship committee should not be considered, should be taken out of the, I would say, the mandatory committees, because then the independent directors' participation will increase. That's what they have said. Again, auditors' tenure. This is something that, again, the SEBI has brought in now. So 10 years, audit partner rotation, the expertise of auditors, again. See, if a large company, and this, in the Adani case, there was this one, that Adani group of companies did not have a big four or a I would say a audit firm of stature auditing the statutory auditors of some of the Adani group companies were not of requisite stature. So that becomes a challenge, right? How do investors view then the audited statements, right? So investors have to rely on the expertise of the auditors also. The fees, again, we look at what is the percentage of non-audit fees in the compensation paid to the audit firm, right? In some cases, there is a logical explanation because certification requirements, limited review, etc. But if in India, of course, audit firms are also increasingly realizing that shareholders are scrutinizing this, so the percentage of non-audit fees is going down. We look at audit comments, of course, emphasis of matter on what percentage of revenue. For example, the statutory auditors of the company write that we have not audited such and such percentage, say 2,000 crores of revenue, okay, are not audited by us, and we have relied on audit statements provided by management or the other auditor. Usually it's a foreign jurisdiction. But yet, if that is not logical, that is the percentage that the audit firm who is signing off on the books of the parent company is very high, then we would look at it negatively, right? So related party transactions, you all know, this is where a lot of shenanigans happen, and investors are very, very closely watching related party transactions, right? And of course, you all know from April 1st, 2022, when the new regime of related party transactions kicked in, about 1,000 crores, especially in conglomerates and groups of companies where more than 1,000 crores needed to be put up for voting by shareholders. So all these became, I would say, important. SEBI, of course, has recognized that abusive related party transactions need to be scrutinized closely, right? And what we look at is we are not against it. There is a logical reason sometimes which could be there for RPTs, but it should not be abusive. There should be validation for it. As long as possible, at least try to give the rationale behind why the RPT is required. Two is what is the pricing, whether you get in fact, we advise companies to, one, ensure that there is an independent validation of the RPTs on an ongoing basis, either by the statutory auditor themselves or by others. In fact, in some of the large companies, based on our advice, they have said that they actually get their statutory auditors to give a statement to the audit committee. The audit committee seeks a statement from the statutory auditors that all RPTs are at arm's length basis, right? On a quarterly basis. So at every quarterly audit committee meeting, the statutory auditor basically gives a statement to the audit committee that it's at arm's length basis, okay? Again, corporate restructurings, this has to be logical, and the valuations have to be fair to minority shareholders. Even to this day, right, some of their transactions become very, very difficult to, I would say, for investors to approve if it's not logical, if there is no fair, the valuations don't seem fair. Okay, I would take the example today. Actually, shareholders are still debating, fighting. Aster DM is trying to sell off their GCC Gulf business to an entity in the Gulf, partly owned by the promoter and partly by a private equity firm. Okay, so Indian shareholders are asking, why are you doing this restructuring? Is the valuation that you are paying fair? Two is the other today live example is ICICI Securities. ICICI as a holding company is offering a share swap, 67 shares of ICICI for 100 shares of ICICI Securities shares. But the non-public shareholders, that is the public shareholders, are not happy with that, right? Capital structure changes, again, this has to be logical and again fair valuations. You know these. So no longer, initially when we started as Ingaman started the business in 2010, we are now 14 years in the business. The New Companies Act kicked in, but yet the investors used to be focused on largely corporate restructurings, any M&A, corporate restructuring, etc. But now even routine proposals like director appointments, compensation, as I told you, compensation is becoming a hot button topic year after year. Any postal ballot that comes to us, investors are looking at it very closely. Any proposal that comes to us, investors are looking at it very closely. Okay, these are the parameters. I mean, of course, you as corporates, this one, you know that the Companies Act has had 100 changes in the last 1 year. So it keeps changing. So you may have noticed these different traits amongst these various categories of companies, right? I mean, at one end, government-owned companies, which is the public sector enterprises, have their own traits. As I already referred to, apathy is one of them. Even sometimes they don't even have the requisite number of directors, independent directors on the board. They don't have women directors, requisite number of women directors on the board. Obviously, some of their policies and all constrain them. They need to seek approval from the ministry, etc. But why do they behave the way they behave? They got to change. That's when they will get premium valuations and they can thought to be as investor friendly. Promoter-owned companies, again, RPTs are greater scrutiny here. Compensation paid to promoter directors, right? We look at how much of compensation. Promoter directors have the advantage that they could always take compensation in the form of dividends. They should not take compensation in the form of, I would say, cash payouts, because they should benefit, their interest should be aligned with that of other shareholders because they have a shareholding in the company. So to that extent, compensation, they should draw, in fact, their compensation should be lower, I would think, than the highest paid professional employed by the company. Okay. So if an executive director is employed by the company as a professional, then the promoter director should take equal to or lower than that, right? So, of course, India listed subsidiaries of multinational companies, these have their own traits. Again, a lot of scrutiny over the past years. Maruti Suzuki, when they spun off Suzuki Motors Gujarat as a separate company and had a transaction with them, they were scrutinized. They had to go on a road show, bring about a big change. Now they have proposed that they'll merge it again with the listed MSIL, right? And the next one is, I would say, Siemens, for example. Siemens also used to sell off some divisions to Siemens AG, which is the German parent, and or acquire 100% unlisted companies at valuations that that was, I would say, difficult to digest by the minority shareholders. So whenever you are selling off a company, it should be fair to the minority shareholders, right? Selling off a division, that is. Banks, of course, because you know banks and insurance companies, they are also regulated by either the RBI or the IRDA. So they have their own, I would say, requirements and regulatory scrutiny. So they have their own traits. From a governance perspective, right? Institutional activism. Who are the shareholders? As you know, globally, as I told you at the beginning itself, these are diverse shareholders. Now, anybody who is registered with India as a FPI can, or even a domestic shareholder can. Of course, see, so there are newer animals of shareholders, right? Now, sovereign wealth funds, some of them, I would say, with a tenure holding of even 10 years, 20 years. I had once visited an investor in Hong Kong where in the conference room, they had actually framed, okay, the share certificate of a company that they invested in 15 years ago during the IPO. Which company would it be? It is Infosys. They said, we have no intention of selling this. Okay, there is this concept called permanent shareholder. Some of these guys are permanent shareholders. They do not think that they will ever sell. They are permanent holders. As long as the company's promoters' interests are aligned to the interest of the shareholders and the companies. So that's where they usually don't go for conglomerates. They invest in usually single, where the promoter's wealth is all concentrated in a single company, right? And there are no RPTs like Infosys. Infosys promoters, their large wealth was largely concentrated, or is largely concentrated in Infosys. And they don't have any RPTs, almost zero RPTs and the like. So these are the types of companies. And this is if you know global pension funds, their holding period is usually their 30 years, 40 years. They don't care. They know that it will be cyclical. But as long as our government and Modi ji talks about $5 trillion, we are going to be a growing economy, we will get there, right? I mean, India is still a young country. Our average age of the country is 29. So globally, all pension funds, endowment funds are the funds held by Harvard and the like, right? Harvard manages about $50 billion of wealth, okay, out of which it's globally diversified. Sovereign wealth funds, you know that Norway, Qatar, Abu Dhabi, Singapore, all of these have sovereign wealth funds which run into $50, $100 billion. And they just want to diversify their financial assets globally. And so India is a growth economy. And you have, of course, every year, especially in 2023, India was the best performing market in the whole world. Okay. Even our GDP growth is the highest GDP growth in the whole world amongst any countries. So these are, of course, metrics. They could change overnight. We don't know. But as we stand now, we are at the cusp of growth. We are at the cusp where we have ambitious that we could reach $5 trillion. We have many of the structures in place. As long as companies don't do shenanigans and just focus on growth in a very, I would say, logical, in a very, I would say, straight manner, all these investors will come and pour money into companies, right? Now, private wealth management firms is a new category of investors. Now they are also PWM firms are managing almost 1 lakh crores worth of assets in India now. Okay, so these are various category of investors. As you know, just last month, mutual funds in India, their AUM crossed 50 lakh crores. That is the headline number. 50 lakh crores is now managed by the domestic mutual funds in India. Right? These are good numbers. Even 10 years ago, our mutual fund industry was struggling to get to 5 lakh crores. In 10 years, it has more than become 10 times. As you know, SIP mutual funds has become like a buzzword, and if you are all not doing SIPs, you should start doing SIPs. I am not a votary for mutual funds in that sense, but yeah, advertisement ke liye they should pay me. Motivation to be an activist. What motivates investors to be activists, or why do they become activists? They want to bring about or demand change, right? As I told you, pension funds are investing for 30 years. They don't want to keep selling and buying and that kind of thing. So they try to identify good assets, and if possible, if there is a possibility of change, small tweaks, etc., they try to engage with management, the board, and they try to bring about changes. Okay? So, on the other hand, hedge funds. What do hedge funds do? They identify inefficient assets. They say, okay, your valuation is very high. I'm going to short you. Okay? Or you could unlock better value by selling off this asset. Okay? Or this division. So these are things that how investors engage. Sometimes it's very overtly, sometimes it is through in one-on-one discussions. Usually these investors go and meet the management one-on-one, that's when they convey many of these, I would say, their asks, so to say. But we are seeing this happening in a very, I would say, now acerbic manner sometimes. We are seeing this happening in a very structured manner. They are going to write in media, they are going to write to the regulator, they are going to garner support of other shareholders to bring about this change. Okay, and how are they going to do it? As I told you, one is engage with company. That is a facet of shareholder activity. Engage means, as I told you, either if you look at the transcript of the quarterly conference calls of companies, you'll notice that many a time, unless or investor fund managers come and they voice their concerns in those transcripts. Okay, but if the company doesn't heed, then obviously either they get battered in the stock or then subsequently many of these proposals could get defeated when they are brought to shareholders, etc. Right? Now we are observing, and we ourselves have been, I will talk about a few case studies where we have ourselves championed causes on behalf of shareholders. Right? Demand changes in directors, management, capitalization, all these are possibilities. Okay, no longer are these this one. As you as company secretaries know, in India, one good thing is I as a shareholder can have the right to place any proposal at a AGM. I can just come and say, okay, I want to appoint Deepa ma'am as a director. Okay, as a director, I just have to go and give 1 lakh rupees. Right? But of course, just like with our general elections, anybody could stand for elections. If you see, actually, even in any constituency, there are usually 100, 200 people standing for elections. Some of them, even 10th pass students, people are standing for election. Then subsequently garnering the votes is a different proposition. Okay. But this is happening. This change, especially in companies where there is a wide dispersal of shareholding, this change could happen, right? And this was manifest in Z just 2 years ago when Invesco nominated their directors. Dish TV also, there was a proposal by Yes Bank to bring about their slate of directors, 6, 7 directors they had proposed, etc. All these were fought for by the companies. But yet, these are changes where there's a splintered shareholding, where because the Indian Companies Act allows many of these, right? Allows anybody to just appoint any other person or himself or herself just by giving 1 lakh rupees. Okay. And you know that even shareholders have a right to call EGMs if they own or collectively own 10% shares. Okay. That's a powerful thing, though it has not been tested many times, but eventually it is going to come. You know, companies like Zomato, companies like all these new age companies, the promoters are owning what percentage of shares? 4%, 5%. Right? In these new age companies where the private equity is owning shares and there are a number of shareholders, what is going to happen? Over a period of time, these companies will become widely held companies. In widely held companies, there is no concentrated shareholder. Okay. And there it will become very, very apparent. Many of these things will pan out. Right? That's where if you see the way ITC restructured or when it spun off ITC hotels, ITC is retaining 40% shareholding in ITC hotels, actually, just to ward off some of these issues. Okay, so we are seeing that, of course, the problem is in India, quickly some of these translates into court cases. Overnight, the promoters then go and file a case in the High Court, and then it becomes a court case. Okay. Unfortunately, even SEBI orders now are sort of, I would say, challenged in SAT and High Courts, and now obviously some of these are getting, I would say, more and more will go to the courts. What we have not seen, of course, is class action suits. That's, I think, though regulatory provision now exists, but we have not seen class action suits. But since regulatory provisions exist, and as I told you, widely held companies, if there are inefficient assets, etc., soon these things will come to bear in Indian markets. I would think in the next 5 years, 10 years, especially when there's a bear market, many of these class action suits will start taking place. Okay. Takeover of companies, again, one big change now for takeover of companies that has happened is, I would think that banks no longer care as to who is the shareholder. Previously, banks as capital providers used to always back the promoters. Okay. But now banks as capital providers, they would say, no, I want an efficient asset, an efficient company. I would back any shareholder, even if you take over the company. And that is a big mindset change from a huge capital provider. So I would think that is a positive change. Financial shenanigans, this is a short break for you guys to just have a moment from the seriousness to just look at it. And obviously, some of these things happened in the past. Hopefully, you guys are not encouraging your companies to do these things. Okay, so please avoid it. And investors, of course, scrutinize it very, very closely. Not just financial metrics, even as you know, with BRSR and other reporting, the ESG reports, it's become important to even disclose non-financial metrics. Soon, even greenwashing. There is audit of the non-financial metrics also, which is proposed now. So all these will become important. So, okay, don't blame the computers. Yeah. Okay. So who is to safeguard the interests of minority shareholders? Of course, see, in some cases, we have also come across where minority shareholders are holding the promoters or the management. They are actually blackmailing in that sense. Okay. So no longer, I mean, it's not that minority shareholders just because should be given all the rights. Okay. It has to be fair to both sets of shareholders. So at one end, the independent directors, of course, are the first line. They should speak for the good of the company. They should not just toe the promoter's line every time. And on the other hand, they should not just say, oh, minority shareholders, we should do everything for them. They should do what is good for the company as a whole and for the future of the company and safeguard the interests of the company. This is where some of these things, for example, when especially valuations of when a company division is spun off or given away, independent actors have to get an independent valuation done. And they have to seek this one, counsel. So this recently happened in the case of this, where independent actors, Raymond, for example, where the independent actors have appointed their own counsel to advise them on what to be done, right? Especially because the CMD came under scrutiny for personal, I would say, reasons, but and there were allegations that company money was used. So that's where the independent directors had to seek a refuge in that. But they have to safeguard the interests of the company, safeguard the interests of the minority. And the second line, of course, the institutional investors carry a lot more weight. Unfortunately, institutional investors, again, will carry a concentrated shareholding and they now are forced to vote by the regulator. So, unfortunately, what happens is they don't fully get involved, or the amount of time and effort they spend on a single company is very limited. Because today, if you see a HDFC mutual fund or a SBI mutual fund, how many shares do they own? They own almost 500, 600 securities in their portfolio across all the schemes. So if they own 600 securities, that means they can literally spend only half a day going through the proposals of one that come at a AGM. And you guys as company secretaries are not just putting AGMs, you're putting postal ballots, you're putting EGMs, etc., etc. So it's like the number of shareholder meetings are also increasing, right? So regulators, of course, the final call, many a time they are scrutinizing, of course, slightly proactive regulator. Over the last 10 years, you have seen what all changes has come about. You have seen right from an investor, enabling the investor through e-voting, through participation in shareholder meetings, etc., etc. The power is slowly shifted from promoters and companies to the investor, right? And the regulator is also not accepting that investors will not act, right? SEBI is come out very heavily on mutual funds to vote, okay? Previously, almost 70% of proposals, you would find that it was abstain. Now, SEBI said you cannot abstain. You have to either vote for or against. So that's where abstain is completely gone out. Domestic mutual funds don't have the luxury of abstaining. Two is what happened in the last 2 years. SEBI also made it mandatory for PMSs to vote. Okay, as long as you are a AIF or PMS, you have to vote. So to that extent, they have pushed other classes of shareholders also to go and vote. Of course, FPIs, foreign investors, have their own agendas. Some of them, the large ones, of course, again, for their domestic investors, they have to disclose. So they do send in their votes, right? Proxy advisory firms, we are sort of, I would say, in between, and we help each of these, I would say, constituents in various aspects of things. As you know, we started in 2010, so it's a journey of 14 years. We have seen the changes in the Indian corporate law itself, how we understand the investor's mindset to some extent, we understand corporate law to some extent, and we understand investment management, how fund managers think and the like. Developments, as you know, mutual funds, domestic mutual funds have to report how they vote. So every quarterly, in fact, they have to disclose how they vote on a quarterly basis. So if you go to SBI mutual fund or any of these mutual funds, you will see that there is a long list of votes that they have submitted for the proposals in that quarter, along with their rationale. Okay. As I told you, they need to show activism. No longer are they, SEBI is sanguine, SEBI is pushing them. And this ADR, GDR holders were given a right to vote in 2011 or 12. Okay. So there is no longer they. Voting disclosures by companies. As you know, previously it was not there. Now this is a standardized format. Is there voting disclosure you have to do, right? Promoter, institutional, non-institutional, which you are doing. Companies Act 2013 provided for e-voting. Again, see, right now MCA is providing for e-voting and even conduct of AGMs through only audio-video means. Many companies are just adopting one. But I am a votary of hybrid, I would say, AGMs. So hybrid shareholder meetings. That is, AGM should be conducted in physical means as well as provide opportunity for people to join the AGMs remotely. MPS, again, this is a development to ensure that there is at least shareholders can block special resolutions at the very extreme, right? Hindering activism, some of these. Today, environment for hostile takeovers is still, I would say, very limited. As I told you, going forward, when these, especially when many of these promoter companies are also transitioning to widely held companies, as the promoter families are becoming bigger. In fact, in one of the old Nifty 50 companies that we are seeing, the promoters shareholding itself is broken down into almost 50 shareholders, 50, 60 shareholders. Of course, it's coming under the category promoter. But I believe that many of these promoter family members are selling shares, selling shares in the market. That means the promoter shareholding itself is coming down at one end. Two is the promoter families are getting split. And three is, of course, these shareholding will get dispersed over a period of time. Okay. Benign lenders, as I told you, till recently, the lenders were benign. They were usually quite silent or supportive of promoters. Now, no longer is the issue. Three is legal hassles. Obviously, many of these end up in courts, especially if there is an activist investor who comes and says, "No, I want to take management or bring about change, etc." Regulatory enforcement, again, many of these take time with the regulators also or in courts, and that is a problem. If courts or the regulator were to quickly decide many of these, it would be faster. All right. Again, institutional investors, as we saw, in some cases, own more than 50% of free float. Okay, promoter-less companies. In which case, Mr. Deepak Parekh, a long time ago, of HDFC also almost lost his job because there in HDFC and HDFC Bank, as you know, FPIs hold almost 75% of the free float equity, or there is no promoter in that company, HDFC Bank, right? So it's all 100% is free float. So FPIs own 75. Institutional investors actively engaged in dialogues with investee companies. Now, I think if a company is not conducting quarterly calls with the investor community, it is viewed at negatively. So now companies have started conducting quarterly calls with investors, and we, in fact, advise companies to engage actively with investors on that basis. To put out the recordings. Some companies are even putting out AGM and put out the recordings on YouTube or on their websites. So we actively suggest that companies should put the recordings of the conference calls and the AGMs on YouTube or on their websites. Right? Disclose these anyway. Voting, as you know, domestic institutional investors have mandatorily to do this. Okay, voting pattern. Indian mutual funds, as I told you, are actively voting now. Routine CG matters, as I told you, are still ignored in some cases, but they cannot abstain from voting. Against votes, overall percentage is still a small number. It is still in the, I would say, single digits as an overall number of votes that the investor votes against, but it is just going to increase, right? Aggressive activism had to pan out. Okay. So just a quick snapshot of our firm. As InGovern, we started in 2010. We assist, as Deepa ma'am had said, we assist companies and institutional investors on financial and reputational matters. Voting recommendations we make for these four types. We have a proprietary corporate governance framework. We have done a number of corporate governance diagnostic and action plan. Can you as a company put in place a robust, these are engagements by the companies to ensure that there is a best practice you're adopting, what disclosure standards to adopt. We have, as I told you, we have even suggested that the board of directors, the number should be increased on policies that the company adopts, the NRC policy, the compensation structure, on what they disclose, etc. Shareholder activism service, we have made regulatory representation, demanded corporate actions from companies, etc. on behalf of shareholders, right? And you may have seen some of this one in the public domain, in media, especially when we come out with a very activist kind of a stance. We obviously are demanding some change. For example, this case study, it happened in late 2021, early 2022. 800 crore markup listed holding company. It was promoter had transferred some shares to their own private entity, and about 3% shares were held by a Singapore-based hedge fund. They engaged our services. We then, what we did, our objective, see, in any shareholder activism, there has to be a specific ask. What is the ask? You cannot just say, I want good corporate law. You have to say, okay, what does good corporate governance manifest in? Does it mean that you've got the company has to go out, give more dividend, or the company has to sell off some business? So what does it mean? Or the company has to engage, we employ more independent directors. So it has to manifest in a specific action. And the action has to be demanded by the investor. This is this one, right? So our objective here was very clear: rollback of the share transfer. Okay. So we spotlighted this to the regulator. When we say spotlight, we meant SEBI. Okay. On behalf of the investor, on behalf of the public investors at large, we went and met SEBI. We told them the transaction, why it was an abusive transaction, why the valuations that the promoter was ascribing to the shares was completely wrong, etc. And obviously in the media attention also, we brought media attention to put pressure on the promoter. Okay. In some cases, it is a very thick-skinned promoter. In some cases, it's a very, I would say, at least a promoter who will act to some extent, right? I mean, in this case, the eventual outcome, this exercise took about 6 months. Eventual outcome was the promoter felt the heat, and then they bought out the Singapore-based hedge fund. They acquired the shares of the Singapore-based at a substantial premium. Even the public, other shareholders benefited because the stock price ran up almost 2-3 times from what it was because of this activism itself. Okay. So while we did not achieve our objective, which is rollback of the share transfer itself, but in the consequence, at least some benefit of, I would say, the stock price run, right? I mean, the promoter buying out shares en bloc, because otherwise it's not easy to sell off 3% en bloc in the stock market. Case study 2, this is in fact sometime in mid 2023 itself. Promoterless company, about 500 crore market cap company, a non-functioning board. In fact, the problem is the board was not functioning. The managing director was very frustrated. The managing director felt that every time, in fact, the managing director had to travel to meet the chairman in his or his town. Okay, he had to move from the head office, go and meet the chairman to consult the chairman of the company. So this was very frustrating for the managing director. Two is the NRC chair, for example. Though she was appointed as a professional outsider, the NRC chair would not even consider, would not respond to a ESOP proposal, for example. If the managing director or the management is placing in front of the NRC chair, the NRC chair should at least respond to the management. But this was a non-functioning board, right? Though it was totally comprised of independent directors, there is no promoter, but yet the fact is that the board was not cohesive. Okay, so we advised the managing director on reconstituting the board. The MD was very frustrated, so he sought our this one. We gave opinions and we advised them on how to reconstitute the board and slowly brought about changes in the board with newer directors. So we also engage with the investors on the need for change, right? Because the other investors are public market investors. So this is defense strategies for a large company. So sometimes allegations are coming to a company, how to defend them. So this, of course, in the private domain, we have advised the management and board on the defense strategies and tactics to be adopted, including we propose some directors on the board in this case. Okay, so this specific instance is in the private domain, so we will not be able to name it, but this is something. So these are the kinds of changes that are happening at the background, right? I mean, if you see, some of these are in the private domain. So we did a corporate governance diagnostic action plan just in the second half of 2023. This is for a 50,000 crore markup company. It was listed 2 years ago, but yet, if you see, we came out with action items, 52 action items. So this is a world management to the extent that they realize that many of their corporate governance structures need to be changed, how to change them, what is palatable to investors, etc. So we went through, in fact, all their policy documents. We obviously brought an outside-in view at a inside-out view, because we looked at the charter documents and how those compare with the best practices in India, right? Detailed corporate governance analysis, and we took the team. See, usually in a company itself, there are various stakeholders, right? Right from one is the promoter, two is the CFO, three is even the HR. Compensation brings in the HR person, because many a time the HR head or the chief people officer does not even know that the company secretary needs this disclosures in this structure, right? People should disclose. Otherwise, the problem is that, in fact, even yesterday we were engaging with a company, a very large company. They are saying, look, we are not paying out any commission to the executive director. Okay. But yet they are bringing out, putting in the postal ballot a line called commission to be paid to the director. They are saying it's an enabling provision. The point is that if you're not paying commission to the director, why are you bringing an enabling proposal? Right? Because the power is going away from shareholders. So this, I think, is the disconnect between the company secretary at one end, who is investor facing, and the HR, I would say the compensation structuring, which is usually done by the HR team. So that's where now, obviously, another stakeholder within a company is the ESG or a sustainability group. So now there are multiple stakeholders even within large companies, right? At one end, the promoter; at the other end, the CFO. The company secretary obviously, unfortunately, bears the brunt of it, because you are structuring the resolutions, putting out the explanatory statements, etc., and that has to be palatable to the investors. Then there's the investor relations team, IR team. So these are the 4-5 stakeholders even within a company. And I think it's important to align everybody's, I would say, viewpoints, that especially when you are publishing in the annual report, when you are coming out with a explanatory statement, you got to be in a format, in a manner which investors can understand. Okay. Because at the end of the day, HR team can have compensation is not so much of an issue. We can give out anything to it. No. Today, investor is looking at very closely whether you paid 1% commission, 2% commission, 3% commission. Each one is a very different this one. How much sitting fees you are paying? Is your sitting fees linked to attendance? Of course. But is even the other commission and all linked to attendance? Or are you paying just a flat this one to all the directors? Okay. So these are, and then shareholder activists. So if you see the shareholder activists globally, of course, you can see some of these shareholders. Carl Icahn is a very storied, I would say, shareholder out of New York City. They opposed Dell's proposal to go private. Okay, they have run campaigns. Carl Icahn comes on TV and says the CEO is a crook. That kind of statement he makes. Okay, so they are very, very aggressive. I have never heard on Indian TV, on Indian CNBC or ET now, anyway, investor calling, oh, the CEO of this company is a crook. Okay, so but in the US, this is the kind of activism that happens. They, in fact, write articles or they create specific websites. Even in one of the cases, we created a specific website for campaigning to other public shareholders, right? Otherwise, how will public shareholders know? Okay. But of course, these shareholders many a time are very aggressive because they want specific solutions, like active spin-off of Motorola Mobility from Motorola Solutions. So they have a specific ask, and once they demand and they get their ask, they move out of the shares. They sell off and they go off, right? One of the big changes is, I would say, Elliott. Elliott brought about change with Cognizant, for example. What did Elliott do? Elliott wrote to and actually brought in, sacked effectively the CEO of Cognizant. Okay. Elliott ensured that there was a change. Many people don't know, even Microsoft, for that matter, Mr. Steve Ballmer was underperforming. Microsoft was very, I would say, almost doing like a public sector enterprise. It was apathetic, the stock was going nowhere, etc. A company called some hedge fund based out of San Francisco, they engaged with the directors, with institutional investors, and then ensured that Steve Ballmer is changed. And who came in place of Steve Ballmer? Mr. Satya Nadella came. The moment Mr. Satya Nadella came, his entire focus, the strategy of Microsoft changed. And now if you see the market cap of Satya Nadella, Microsoft, since Satya Nadella took over, has increased almost 10 times. Okay, it used to be about $300 billion of market cap. Now it is almost $3 trillion, almost equal to that of Apple and the like, right? So these are aggressive, I would say, activists in that sense, but they have a specific agenda, right? They have one agenda that they want to pursue. Okay. And so these are, in India, do these kind of shareholders exist? Yes, they do. But in small companies, and as I told you, they don't come and they call, they don't, we have still not seen the kind of shareholders who are very, very aggressive. They don't come on TV and say, oh, the CEO of this company is cheat and that kind of thing. That is yet to happen in India. But slowly in small companies which is widely held, it will happen, and it is happening in private, and it will happen more aggressively. Okay, but we all know this case. January, exactly 1 year ago, all of us have now very, very familiar with this name as a short seller who came and shorted all Adani Group stocks. Again, see, we have, as an Indian capital markets, it's good. Some investor who is based in New York City is coming and shorting Indian shares, saying that these, it's basically saying that, oh, whatever the reason, forget the reason, the allegations, political, this one subsequently, etc. But what is the benefit of these kind of investors? One, they are basically identifying inefficient assets. Two, they are saying that as long as they are basing their research, as I told you, we still have not seen that. But Hindenburg did call the Adani as the biggest con in corporate history, etc., etc. But they had a motive. Their motive is to benefit from the inflated stock price. They had shorted and they were very open about it. And then the moment the stock price went, obviously they may have squared off their positions and they have made good money. And that is their business model. In fact, just 2 months ago, they wrote on one company, one Chinese company, and that stock climbed 84% on the day that report came out, Hindenburg report came out. And they would have made tons of money, right? I mean, 84% stock crashes in the US. In the US, there are no circuit filters like in India. Okay. So at 84%, you made a fortune. Okay. So other investors, obviously, the company then has to go out. If suppose it's a false allegation, the company has to go out and garner support of other investors. So that becomes important. You may say that, oh, Hindenburg is reporting wrong data or wrong this one. Then they will be under scrutiny by the regulator. Okay. if they are using wrong data or making allegations which are not fair. Two is the company, that's where it becomes important that the company has also engaged with other investors, be it mutual funds. On a continuous basis, if you are engaging with the other investors, those other investors trust you as management, and that is what is important. Okay, any questions? I think now I have completed almost 1 hour 45 minutes. If there are questions, I'm happy to take them. I hope it was insightful. That is what I was trying to do. Because shareholder democracy, I am not talking about corporate law. Maybe you guys know the law better than I do. But the important thing is to use the provisions of law and how investors are using the provisions of law. Because, of course, mutual fund managers and all don't understand the Companies Act, the nitty-gritties of Companies Act, whether this requires two-thirds shareholding votes or one-third or a special resolution. We have to, in fact, explain to them what is a special resolution, what is an ordinary resolution, etc. But that becomes important. So please ask questions either through Deepa ma'am. I don't know the mechanism that you have.
So, indeed, it has been very informative. And actually, it comes from your personal experience, all the companies that you've encountered, the issues that you've seen, that you have brought to us.
Sorry, I did not see this one.
No issues, no
But
issues.
that's fine. Yeah, I don't mind because these are there in public domain. So, and
Yes.
our statements, comments are also there in public domain. So
True.
we are not this one about that. Yeah.
So, if we talk about shareholder activism, how far can it somewhere control insolvency and bankruptcy in time?
Yeah, to some extent. See, obviously, till date, we have not seen because usually at that time when it comes to IBC, the shareholder value should ideally be zero. One. Two is, or if suppose there is a concentrated shareholder who is willing to accumulate all shares or take all shareholders together and take the company to insolvency, for example, then there's a possibility. Till date, we have not seen that one concentrated shareholder is taking the company to insolve IBC. That could also be the case, right? It's almost like a class action suit in the IBC or something of that sort, where they are willing to buy off the company at a very low this.
Rather not taking into IBC, but preventing it from going into IBC. Matlab, in time, just कहते हैं ना, prevention is better than cure.
Yeah.
That kind of a thing.
Yeah, so they've got to infuse capital, right? They have to believe in the future of the company, and somebody has to bring in new capital. So if some shareholder wants, say, 10%, and that shareholder is interested in bringing more capital in, then possibility exists. We obviously those things will play out, but we have not seen examples of that, especially in any listed company, large listed company.
And over the past few years, or rather in the past decades or so, we have had plenty of cases of insider trading.
Yeah.
Can shareholder democracy and activism, avoid such issues or curtail them, contain them in time? How can
See, this insider trading is more of, I would say, driven by human greed, right? There is nothing to do with shareholder democracy in that sense. It can only push companies to, I would say, adopt fair practices. In fact, large companies, as long as the management is very conscious and has systems and processes in place, because even large companies are, I would say, susceptible to it. It need not necessarily be any fault of the management per se. But especially, so this has become very tricky. Now, SEBI is very looking at it very closely. But if you have seen, even many of the SEBI orders have recently been overturned by the SAT. Because and SEBI doesn't have a good track record of, I would say, prosecution there or even investigation. PIT regulations, of course, are onerous on the company also a bit, but it has to, companies have to embrace a culture of, I would think, secrecy when it matters. But this has got nothing to do with the external shareholder. The shareholder can only push the companies and demand, I would think, companies which don't have systems and processes in place. There are, of course, at small cap companies which explicitly engage with investors, which provide insider information and all these things. And regulatory enforcement, surveillance, and all these are, the regulator has to do much more there.
So, these days we are seeing a surge towards the SME listed side. The MSMEs are getting listed.
Yeah.
How can we, how, as a shareholder, how can somebody play an active role and have some say on the board? Because MSMEs, the information that is in the public arena is also very limited about these companies, and things might not come out until it's too late.
No, so obviously it's now reached a bubble territory, right? The MSME, I would say the stock, in that sense, prices and the valuations. But that's got nothing to do with the disclosure regime, the bare basics of what the companies disclose, quarterly disclosures are there, audited reports are there. So all the, I would say, structures of the Companies Act and the LODR apply to them also. So to that extent, I would think the MSMEs are also, I would say, under greater scrutiny. In fact, we are working towards helping more MSMEs, SME listed companies towards many of these corporate governance parameters. We are doing corporate governance diagnostic and action plan kind of service to a couple of SME listed companies now, because they require, for them also, see, some of the evolved SME companies are moving to the main board also. If they are aspiring that they have taken the capital from shareholders and they want to move to the main board, so they've got to embrace more investors friendly practices. So I think that change is also happening. In the last couple of years, at least about 10, 15 companies have moved from SME list exchanges to the main boards.
So this was something even I was wondering, and one of our members has also raised this question. How has the journey of InGovern been like? Like when you started off and where the firm stands now, how has it been like?
I mean, so obviously, see, it was an entrepreneurial journey. I used to be with Infosys Consulting. I thought that in Feb 2010 was when SEBI came out with this one that domestic mutual funds need to disclose, have a voting policy and disclose the voting. So I thought that this will actually help India from a perspective of me assisting or InGovern. So we set up the company, incorporated the company in June 2010. So it will be 14 years this June. But yeah, I mean, just like with an entrepreneur, small company, we are not like a large company. We don't do any other services apart from what we are. So we are, of course, focused research and advisory firm. We have, obviously, it took time for shareholders to understand, investors to understand what is voting. How, in fact, the first year when we went, they were not even aware that the regulation applied to them. Right? So, in fact, over a period of time, now only SEBI is doing discussion documents, for example. So, market participants are aware of what is going to come as regulatory changes. So, over a period of time, we have seen that things have changed. And now, at least over these 14 years, the fact that we have been there for 14 years is tells something. And we are seeing increasing interest from companies also to embrace good corporate governance practice and engage our services. Of course, investors at one end, there are the large institutional kind of investors which have diverse holdings. And as I told you, they don't tend to spend too much time because they have like 600 holdings in their portfolios. At the other end, there are these concentrated investors like the hedge funds and all who own only 10 stocks in their portfolio, 15 stocks in their portfolios, etc., and the private wealth managers, etc., who want to bring about specific change or are demanding specific corporate action, and then they engage our services for that.
As individual investors, how can people be informed enough to be a part of this journey of activism? How can they play their roles properly?
See, individual, obviously, because the topic itself is shareholder democracy. In a democratic, as you told, if I own one vote and I vote for party XYZ, still BJP or Congress or any other party may itself come. Party XYZ will not come. So it is very difficult unless one, as an individual investor, one, I have influence over other shareholders. So I need to garner support of other shareholders. If suppose you do deep dive research, even if I own 100 shares of a company, but I do deep dive research and I am willing to write out a compelling letter or a compelling note or compelling. Today, media will carry it. Two is you can garner support of other institutional investors. Okay. So it is possible. But these are extreme cases, right? I mean, you got to know what you write on. Okay. Today, even a private wealth manager is actually becoming activist in the form of opposing a proposal. Okay. So by garnering support of other investors, okay, or publishing it in the media. So the company at least takes note of it, right? Two is there are, I know, high net worth individual investors, retail investors in that sense. They in fact write very regularly letters to the MDs of companies. Okay, letters means, I mean, both on a positive side as well as on a negative side. If they observe something that the company is not doing properly, they write to them. Okay, so to that extent, it may not be in the public domain, but it is something that you have sought to change, or at least put the company on note. Okay.
But how much is the company obligated to react on that?
No, they are not obligated to react. So that's where, as I told you, there are thick-skinned companies and there are companies which will at least take note that you have written to them. Some companies respond to the investor emails. In fact, we get some investors copying us, writing to the company management, but copying us in their email. And then the company does respond. At least they respond with a response. Some of it is, of course, lawyered response, so to say, which is almost like a lawyer response. But yet, you know that the company has taken note of it.
That's a good way of bringing it to their notice.
Yeah.
So a very specific legal question in front of me. It says if promoter shareholding decreased by 30% in one quarter and company has not informed it to the public at large, apart from filing of quarterly filed shareholding pattern, in that case, what are the remedies available in hands of retail shareholders? Or what needs to be disclosed by the company in that situation?
They must have taken the depromoterization vote, I would think, right? Firstly, how did they become 30% without depromoterization? That proposal should have been placed. Maybe the shareholder missed that out. Two is obviously the company. Suppose I presume legally they are correct. They have taken the shareholder proposal. If they have not taken the shareholder approval, obviously we can write to the regulator. SEBI will take note. But if they have taken shareholder approval, then there is nothing to be done, right? I mean, so then obviously in the quarterly disclosure only the promoter shareholding will, the classification will change.
Can small shareholders directors bring about big change?
Yeah, it hasn't happened yet because the influence of the small shareholder directors is very less as of now. But hopefully, some of them are attending this conference webinar and learning, and in the process also knowing that their rights and responsibility are important, because they are also responsible. So one good thing that the regulations have now done is they have freed independent directors from prosecution if they are not party to the fraud. But if the director is party to the fraud, then obviously they are. So to that extent, they have a responsibility, right? The small shareholder director have a responsibility to ensure that the disclosures are proper, they get sufficient information from the promoter and the like. So they have a right to question. So they have a right to question the promoter. They should question the director, the promoters.
And so, only just in your presentation, we discussed about the fact that there are legal hassles of taking up something like activism or pursuing something. How can there be a balance in that? How can we go about doing the work, getting it done, and not going through the legal hassles?
It's not easy.
Possible
But
recourse.
see, it requires tremendous, I would say, resources in terms of either time, effort, money. Even to hire a lawyer or anybody for that matter, it takes effort for a resources for a shareholder to do it. In fact, in the case of one future group companies, we tried to do a class action. Somebody was interested in class action suit, but to put together the 100 shareholders that is required and to put garner some money, etc., to file and all, it takes effort and resources that.
So, in that scenario, the issues that need to be brought up might be not able to be carried out.
Yeah. So it's not easy. It requires tremendous commitment, is what I would say. It requires motivated, I would say, even investor. You should be almost like that's where it's called activist, right? I mean, it's not like a normal write a letter to the MD and change will happen overnight. So it requires a motivated, concentrated effort, perseverance, and persistence.
Like you just mentioned certain names of the people who have been good activists in the outside countries abroad. It's strange that with ours being the oldest stock exchange, we have been around in the share markets and stocks and capital markets for so long. How come there is nobody here who's doing all that?
No, it's slowly happening in the private domain, I would think. Many of the activist investors in India don't want to be seen in the public domain. They keep a slightly low profile. And some of these foreign guys are also present in India. They keep a very low profile. They want to bring about change. They try to bring about change also in a very low profile manner.
Okay.
Yeah. But that will change. That will change. See, India, one only thing is the shareholding pattern in India. There aren't too many widely held companies in India. Okay. Shareholder activism is most amenable if the companies are widely held. And there are various sets of shareholders with various interests, so to say. Okay. In India, usually it has been concentrated shareholding. So either promoter shareholding, where the promoter shareholding is very high, public sector, of course, the government owns a huge percentage of shares. In fact, in 2011, I don't know whether how many of you know, there was a fund based out of London called the Children's Fund, which tried to be activist against Coal India. Okay. Coal India, they wanted Coal India to give out dividends of 50,000 crores. And in fact, they set up a website for that, Coal for India. In fact, I have a copy of that website. Maybe I should have put a slide there. Then they wrote a letter to the Ministry of Coal. They wrote a letter to the Finance Ministry. They went and met the coal secretary. They said because the government of India owned more than 90% at that time of Coal India. So they said that if India were to attract more private capital, first of all, these companies should be more investor friendly. Coal India should not be sitting on 50,000 crores of cash. We either should pay out it as dividend. One of the things that Coal India does not do is actually wash the final coal. If they were washing the final coal, the quality of coal would improve, and then their realization per kg of coal they sell could improve. This was one of the recommendations by this fund, that if you actually, rather than sit on cash, use some of this to invest in washing the coal, your realization per kg of coal will increase, and that would benefit shareholders. So you are using capital inefficiently by just sitting on 50,000 crores of cash. Do it out of dividend, etc. So if you see a company with market cap of say 1.5 lakh crore at that time, or 2 lakh crore, giving out 50,000 crores of dividend would mean almost like 25% return to the shareholder. So if you buy 2 lakh crores worth of shares, you will get like 50,000 rupees as dividend.
And sir, right now you mentioned about widely held companies. So how come are they better than promoter held companies? Is it not wrong for a company which is functioning in a certain direction to have shareholders with different interests, and they all of them wanting it to be in their way?
Yeah, that's true. That's bound to happen. That's where then the I would say the powers of the board becomes very important then. So the widely held companies then become very susceptible to the control by the CEO and the board. Okay, if there's a widely held company, the role of the managing director or the professional, because the CEO or the managing director doesn't have much shareholding, right, or would have the control. And two classic examples in India: L&T and ITC, right, where the board, the composition of the board, and the power exerted by the CEO becomes very important.
And I guess both the companies are doing good on the shareholders front.
Yeah. But of course, they have had their issues in the past sometimes. So as of now, of course, they are highly held, and they have processes in place at least which are investor friendly. But your question also applies to now these new age companies, as I told you, which will have market caps of 1,000, 2,000 crores, 3,000 crores, and all. And those will, one, of course, there is a possibility of hostile takeovers. There is a possibility of them coming under bad times, continuing to do losses over a period of time. So all these will happen. Today we are in bullish markets, so many of these, I would say, are not scrutinized so closely. But come bearish markets, when markets tank 20%, 50%, etc. So then we got to see how the board behaves, how the company behaves.
At the end of the day, it's more like a bubble.
We will not call it a bubble. The bubble is in pockets. As I told you, in the SME, especially, there are some stocks which are in bubble territory. This is the expectation built that India will do very well, right? And that is where I think one is, of course, the China plus one strategy is playing out. The PLI schemes by the government is playing out in the manufacturing, the push to railways, infrastructure by the government, and everything is playing out. So many stories are playing out for India. Globally also, all investors, in fact, in 2022, if you see, the net outflow by FIs was almost $50 billion they had sold, FPIs. But in 2023, they came back again. They invested almost, I would think, $80-90 billion. The net new money came into the country by the FPIs. So I would think globally, in fact, today I was reading a news article which said that the China market has gone down 45% from its high in July 2021. So today, China's index is down 45%. So where is the money going? If people are selling in China, they are bringing that money into India.
That is a blessing in disguise.
Yeah, I mean, as we all know, money is fungible. I mean, so of course, if India gets its acts wrong, that money will go away overnight. If suppose the US increases rates or keeps holding the interest rates as it is, some amount of money will go back to the US itself. Okay, so obviously we got to get it right. Companies also have to get it right. Right. I mean, it's of course markets doing good is fine, but if our neighbors are doing well and we are not doing well, that is not good. So we means I'm saying talking about a specific company. We as a company or a company secretary who is here, each company has to do its own bit to it. Right. You have to do investor outreach. You have to do investor conference call. You have to, as company secretary, influence your promoter to actually be more investor friendly. You have to tell the promoter. Sometimes it is so surprising. Even a 1 lakh crore company is paying out huge, the highest compensation to the promoter directors. Why? I mean, if you hold 40% of the company, give it out as dividend, no? At least the stock price will go up.
So there's a very technical question that is there. It says, what code of conduct or governance mechanisms, including values that are embedded in shareholder activist companies and their teams, while deep diving for the benefit of minority shares into the information from target companies that are not in public domain?
Can you break it down? And companies are not in public domain, or the investor is not in public domain.
Basically, how are we to go about hunting for the information which is not available in the public domain, but which might impact our decision making? Or acting as an activist?
I'm not sure I understand that question, but see, obviously today investors are doing what is known as scuttlebutt. Scuttlebutt is they actually go and meet dealers, they go and meet other stakeholders, etc., to find out what is happening with the company. They meet ex-employees at senior levels to find out what is happening with the company. So that's how, as these hedge funds and all are gathering more information about the company, right? I mean, so you or me as a retail investor sitting at we can only have access to Googles of the world and the MCA website, and of course, see, in fact, the MCA portal itself is a rich, this one, if you are able to trace the good part is, even a small company like InGovern, we have to upload our financials, right? In India, unlike the US, in US, private companies don't have to give their financials in the public domain. But in India, any company, the moment you are a LLP or a private limited company, you have to file your annual filings with the MCA. Of course, that MCA V3 may not function properly. That's a different thing that you as ICSI should take it up. But at least it is available in the public domain to the extent. So you got to then, as an investor, I would say, go through that, trace this one, put in the effort, etc. So if you have to do, where did the money go? What is the nature of the private limited company owned by the promoter? How much is their revenue, etc., etc. You can dig deep in. That is a possibility.
If a casual vacancy in a listed company board is not filled in and the company fails to do so, what would be the next step?
Next step for the company or for the investor, I think you can put the company on notice. Two is obviously you can write to SEBI. See, the moment you copy SEBI, at least the companies become slightly more hesitant. So you got to be more activist, or you can write to even journalists. Journalists are always looking for stories. So that is one aspect that you as an investor can think about. If you think that a casual vacancy is not filled, you can write to a journalist, the journalist will pick up the story.
My last question would have been about the role of company secretaries, but I guess you would have covered it up.
Yeah, see, obviously the company secretary, unfortunately in India, is, I would think, not so much, I would say, is not treated as an advisor by the promoter. Very few companies actually treat the company secretary as an advisor to them, right? Especially on, but for the legal matters, in that, oh, are we compliant with the Companies Act? Beyond that, okay, can we do, that's where I think you as company secretaries also need to be more educative of how investor friendly policies are, what policies we should adopt to be more investor friendly. You got to be interacting, part of the IR team. Why shouldn't you be attending even the conference calls, quarterly conference calls, to at least see what are the concerns of investors? Many a time I don't see a company secretary being present there, right, in the quarterly conference call. The IR team is there, but the IR team is giving a very layered answer, I would say, I would say, what the investor wants to hear type. But the underpinning of the investor concerns, the company secretary probably should understand and then reflect it back to the management. And of course, in subsequent explanatory statements or disclosures, etc., you can bring about that change.
Basically, we can take it up in the actual documentation.
Yeah. No, you got to impress upon the promoter or the board, right? I mean, this is what it should be.
So, anything else you would like to share from your end? I'm done
No,
with
I
my
think,
questions.
see, obviously, it's a long journey for companies, especially. But the opportunity is definitely there. You got to reach out to more number of investors. I like companies where the number of investors is increasing by the quarter. So that means that the shareholding pattern is becoming more diffuse. If the number of shareholders is increasing. So one metric for you as a company secretary and to impress upon your IR team is, can we look at this as an internal metric? Because non-promoter shareholders, if the number is increasing, then that's a good thing. And obviously the concentration of shareholding also matters. And I'm sure many company secretaries here are smart. So they recognize that corporate governance is important. One, two is corporate governance diagnostics. At least you can look internally, hold a mirror to yourself and see whether this, where are we lacking before the shareholder becomes an activist. See, many a time the companies also, what we notice is the company puts out a notice of shareholder, okay, for voting. Then they realized, oh, when we engage with the company, oh sir, you should have told this to us before, kind of thing. We say, Array, how can we tell you? You not even reached out to us. If you had evangelized, reached out, or done something before you put out the proposal, then we could have told you that this is how investors would expect things to have. So in fact, some companies started engaging before putting out the notice. Okay. At least the broad contours of what should be disclosed, kind of thing, which is already there in our guidelines, voting guidelines. But more importantly, for them also to get inputs on what to present to investors.
So, I guess we are ending this on the note of prevention is better than cure.
No, I don't want to end. The prevention one is definitely better than cure, but more importantly, there is a very huge opportunity out here. India is at the cusp of things. We companies today, which are, I would say, X, can become 10X in the next 10 years. So I think that as companies and company secretaries and you guys as advisors to promoters and management and boards. So to that extent, you got to, I think, look at it positively. Of course, SEBI will keep coming out with regulatory changes. We have to be on top of it.
Sure.
And we have to get the MCA V3 working for that.
That we are trying. Rather, the ministry is trying really hard on that. So it was really an informative session, really knowledge enriching. And personally, I have so many takeaways from your session. It was really good having you amongst us. Thank you
Thank
so
you.
much for today.
Okay, thank you. Thank you. Bye.